Okay, this is chapter 2. Course is still in Managerial Accounting. This is our second class. So from now on, we're going to start talking about the cost. Before I start talking about the cost, a few things that I want you to understand. We're going to do different classification for the purpose of cost and how we understand the costs. But we never be able to change the total. So what we're going to do for one purpose, we're going to split the cost one way. For another purpose, split the cost different way. For the third purpose, we're going to split the cost for different way, but we won't be able to change the total. The total is the same because the cost is something that already happened. What we're going to do, we're going to prepare different classification and different reports for different purposes. For example, let's say I have 40 students in the classroom. How many classification I may have on those students? Different. I may run the classification based on the hair color, based on the length of the hair, based on the weight, based on the height, different, but I'm not going to change. I won't be able to change the number of the students. I'm always going to have 40 students at the end of every report. Make sense? So we not duplicate data here when we're doing the cost classification. So let's start with the first cost classification. First cost classification, as we start last time, was about the product. So every product, in order we to make that product, we have to have three essential costs: direct material, direct labor, manufacturing overhead. Direct material is any raw material that's using for the production of the product, which is essential part of that product. That's direct material. Direct labor is the labor that we can trace easily to that product. Now we're going to the manufacturing overhead. What's manufacturing overhead? Manufacturing overhead will be everything that cannot be easily directly traced to the specific product. Manufacturing can include indirect material, indirect labor, some other parts, some other elements like utilities, like a security, like a depreciation of the machine that we're using. Anything like that will be related to our manufacturing overhead. So that's how we get the product. For that reason, product is gonna different classification. What we can make is from direct material, direct labor, since those coming first. Direct material always comes first, direct labor comes second. So since those two are the first on the line, we're gonna call it prime cost. Prime cost means first. Once we have the first direct material, direct labor, then we're gonna make another classification. Direct material, direct labor, and manufacturing overhead. We're gonna combine it together and gonna say this is our conversion cost. Why is conversion cost? Conversion cost is because converting the raw material or direct material, in this case used, into the product. Direct labor and manufacturing overhead are the one that converting that material into the product. Without direct labor manufacturing overhead, the material is going to stay material and nothing is going to happen. We're not going to have a product. How are we going to treat the overtime? Obviously, all of you know about overtime. You're familiar with what overtime is. Since you're on the evening lecture, most likely you're already working, so you know what the overtime is. For the purpose of our production, how are we going to treat the manufacturing overhead? Are we going to treat it as a part of manufacturing overhead? And product-specific overtime will be part of direct labor. So it depends. If the overtime premium for all factory are usually considered to be part of the manufacturing overhead, but the product-specific overtime premiums are part of the direct labor. Non-manufacturing costs which are not directly related to the process of production. So manufacturing costs, we saw the manufacturing costs of direct material, direct labor, manufacturing overhead. Non-manufacturing costs are the ones that are related to marketing and selling costs. we need those costs, as you saw the first chapter, through the value chain of the company in order to sell our product. The other part of the non-manufacturing cost is the administrative cost. Those are costs for the executives, for the accountants, for the clerical cost, anything related to that part of the cost. So first classification will be based on production cost and period cost. Production cost, again, are direct material, direct labor, manufacturing overhead. How are we going to treat them? First, they're going to go to the balance sheet. That's why sometimes you're going to see that product cost called inventoriable cost as well. Why? Because first goes to the inventory as a finished goods. Once those finished goods are sold, become cost of goods sold, part of the income statement. On the period cost, those are directly expensed. They're not part of the inventory, directly expensed. Selling administrative costs are directly expensed. Now let's do this quick question. Which of the following costs will be considered a period, mean directly expensed, rather than the product cost for a manufacturing company? First, manufacturing equipment depreciation. What kind of cost do you think that will be? Period or product cost? Any suggestions? Any guesses?
Product cost.
Product cost. Why? Because it's related to the manufacturing. Manufacturing process, manufacturing cost is a product cost, okay? What kind of manufacturing, what kind of product cost will be? Is it direct material? Obviously not. It's a depreciation of the equipment. Is it direct labor? Definitely not labor. So the only option that we have is to be manufacturing overhead. Property taxes on the corporate headquarters. Now, since the corporate headquarters are not related to manufacturing, that will be pure period cost. Direct material cost, that will be directly product cost. Electrical cost of the light of the production facility. Since the facility is used for production or manufacturing, means it's related to the product, definitely will be product cost. The question is what kind of product cost will be that? It's not direct material, out of question. It's not direct labor, out of question. So it left to be the only one, manufacturing overhead. Sales commissions, since those sales commissions not related to the production, but related for the selling of production, that's pure period cost. So the answer here will be only the property tax and corporate headquarters and sales commissions are period cost. Everything else is product cost. Now, how many types of businesses we have in North America? That we have three types of businesses. First one is the one that dealing with service and service only. Second one is merchandiser. And the next one is the manufacturer. Service companies, they barely have any inventory. So for that reason, we're not going to talk too much about service company. But merchandiser, what's interesting for merchandiser is they buying direct finished goods and selling finished goods. They're not involved in production, manufacturing of those goods. They're just buying ready stuff and selling the same stuff. So for example, if the company buys computers, it's going to sell computers. If the company don't buy cell phones, obviously it cannot sell cell phones because they just don't have it. They have to buy it first and then sell it. Manufacturing company. Manufacturing company is the one that buying the raw material, hiring the labor, and then producing and selling those finished goods. What's interesting on the balance sheet, how are we going to present those on the balance sheet? Merchandiser, we're going to have only one inventory account. That will be related to the merchandise inventory, and that's all. Now, how many different merchandising inventory accounts we're going to have? That's a different question. Depends on the product that we're buying and selling. But at the end of the day, the whole account will be called merchandise inventory. Different sub-accounts, but merchandising inventory. Now, in the manufacturing company, how many inventory accounts we're going to have? We're going to have 3 inventory accounts. Why? Because first we have to buy a raw material, so we can use that raw material as a direct material. Second, once we start working the work material, since we have a reporting date at the end of the month, there always will be products which are started and not completed. For that reason, we're going to have this account called work in process. That will contain products which are neither products, neither finished goods, somewhere in the middle, and stay in that account. The last account, inventory account that we're going to have for the manufacturing company, it's finished goods. Finished goods, those are the goods that are produced. They move out from the working process and stay in this account, finished goods, so ready to be sold. That's the explanation for what I just said. So now the question is, how are we going to get cost of goods sold in each of the companies? In the merchandising company, it will be easy. Cost of goods sold always will be equal to simple calculation, the beginning balance of the inventory plus the purchases that we currently made. That's going to give us available inventory for sale. Once we deduct the ending balance, we're going to get the cost of goods sold. For the manufacturing, yes.
So I have a question about the page 13. So for the working process, does this include the labor pay?
Yes.
For the pay
yes. For the working process, it's going to include. I mean, it's hard to tell. It's going to include the labor. Depends. That's why it's working process. It might be raw material which were already transferred into the process of being work as a finished good, but the labor might not have started yet. Make sense? Or to some of the product. On some of the product, labor is almost finished, but there's still some indirect parts that are waiting to be completed. So that's why in the working process, it's hard to tell where exactly is the product. But yeah, definitely we're going to have portion of direct material, portion of direct labor, and some kind of manufacturing overhead, but the product is not completed yet. Make sense?
Thank you.
That's something somewhere in the middle. So, for example, I'm going to give you example. Imagine this: you start cooking chicken with potato. You cut the potato, you cut the chicken, you put the chicken to boil, and now 6:30 you have to start the lecture. So what you're going to do? You're going to turn on the stove, let the chicken stay there, put some water in the potatoes. Otherwise, if you don't put the water, they're going to become dark. And listen to the lecture. Once you finish the lecture, you're going to keep cooking. Did you start using the materials? Yes. Did you put already some labor? Yes, you did. Did you put some manufacturing overhead? Yes, you did. You use some electricity. You use some of the oven, which can be transferred as a depreciation. Is the dinner ready? No, it's not.
Thank you so much.
Right? That will be like a working process. Now we are in the process of working, but it's not finished yet. Once the dinner is ready, we're going to say, that's it, finish. Now we're waiting for the customers to come. Once the customer come, we're going to serve the dinner, take the money, and run away. Okay, so manufacturing company, how are we going to get that cost of goods sold? Same idea as a merchandising company. We're going to get the beginning balance of the finished goods account in this case. We're going to see how much is the cost of the goods that we manufactured. Because in this case, we're not going to purchase them. We're going to manufacture them, but they're coming with the cost. So we're going to see how much is the cost of the goods that we manufactured. That's going to give us the how much we have available for sale. Once we deduct the ending balance, we're going to get cost of goods sold. So now, before I continue with the rest of the slides, let's go and do some exercise on the Excel spreadsheet. But before we do that, I want to format one Excel spreadsheet so we don't have to spend too much time here. So the whole idea is we to recreate the process in the company with the property accounts. I'm not sure if you know, but I kind of like it, the T accounts. If you took that 1110 with me, probably you already know that. Okay, I'm almost done with this. And in a second, I'm going to share my Excel spreadsheet. And we're going to start working. Okay. Let me stop sharing this first and move to the next sharing. Okay. Can you guys see my Excel spreadsheet?
Yeah.
Okay.
Yes.
So let's work on this Excel spreadsheet. First worksheet, we're going to call it that obviously merchandising company. Merchandising company. So in merchandising company, we said we have one inventory account, right? Beginning balance, ending balance is ending balance. There's nothing tricky there. On the left side, we're going to have our debits. On the right side, we're going to have our credits. That's your T account. Very simple. Inventory because only one account, merchandising inventory. That's all. So again, in order to sell something, what we have to do?
We need to purchase.
We need to purchase those ones. So let's purchase them. Let me get insert some of those fancy here shapes. Let's purchase something. We're gonna purchase, right? Once we purchase, we're gonna have inventory. Once we have the inventory, now we can sell it, correct? Because if I don't have it, I cannot sell it. Once I sell it, that will become cost of goods sold, right? We're gonna have sales, we're gonna have cost of goods sold, then we're gonna have gross margin, then we're gonna have operating expenses, and at the end, we're gonna have operating income. That's how it is. Traditional format income statement. Sales, cost of goods sold, gross margin, operating expenses, operating income. So the cost of goods sold in this case is going to come from this account. From the inventory account. So what is the basic equation for the T account? Basic equation is very simple. Beginning balance plus the debit. It's always equal to credit plus ending balance. Make sense? Sounds right, right? So let's test this one. So if I want to find our credit, which credit here represents cost of goods sold, what do I have to do? I have to express credit to be equal to beginning balance plus the debit minus the ending balance. Correct? Now, again, credit in our case here, all the credits represent cost of goods sold. All the debits represent our purchases. There's no other options here. So in order we to sell, we have to purchase it. In order we to, what I'm looking for this. Not that particular, but we can use it. That's our cost of goods sold. That's our purchases. That's how we get cost of goods sold. That's how we get the purchases, right? Once we purchases, we have something. Once we sell it, we have cost of goods sold. Done. Now let's try to test this equation. Imagine this. You have in your pocket $5. You want to go for shopping in Metrotown. So you went to the bank account, you withdraw $200. You just like cash. You don't want to pay with credit card. You withdraw $200. How many dollars you have available for spending?
205.
205. You went to Metrotown, you spent $180. The question is, how many dollars you have in your pocket now? Again, you had $5, you withdraw 200, you spent in Metrotown $180. How many dollars now you have in your pocket?
$25.
$25. Make sense? So how do you get it? The ending balance here in this case is equal to beginning balance plus the debit that you put in minus the credit that you take out, correct? I want you to understand, I'm going with the debit and credit because I want you to understand that debit represents what's coming in, credit represents what's going out. Now, in different accounts, we're going to change the terminology, but that's not going to change the fact that this is just simple debit and simple credit. Now, what we're going to do in this case, in the inventory, we're going to replace the debit with purchases, and credit during the period, we're going to call it cost of goods sold. And that's how we're going to get this. So, for example, if my beginning inventory is 20 and my purchases are 100, now let's say my ending balance is 5, how much is my cost of goods sold?
115.
115. Right? How did you get it? Beginning balance plus the purchases, 120, minus ending balance, 115. So in other words, you can do it easily. Beginning balance of the inventory plus, we're gonna add here, plus purchases. It's gonna give us inventory available for sale. We're not gonna keep that inventory, we want to use it. But since we're selling the inventory available for sale, then we're gonna deduct. Here we can go less. Let's go less. Ending balance of the inventory. And we're gonna get cost of goods sold. That's for the merchandising company. Let's put it here. Let's instead of plus, let's put add purchases, and we're gonna get. Now the only thing is we have to put the number. We gotta have 20 here. Purchases are 100, and then we're gonna have the first calculation, which is 120 in this case. And after that, ending inventory is 5, and we're gonna get cost of goods sold, which is this one, minus ending inventory. And we're done. Make sense? That's how we get cost of goods sold in this merchandising company. What we have to do, we have to go once to metric ton. That's in that cost of goods sold. We're going to replace it directly in this formula here. That's from where we going to get cost of goods sold. That's one way to do it. The other way will be simply getting the sales and then get this thing all together and flip it here. And after that, you're going to calculate the gross margin. After the cost of goods sold, you're going to have gross margin and the other two, operating income and operating expenses. And we're done. That's another way you to come up with the cost of goods sold. That's for the merchandising company. Let's now move to the see what's happening in the manufacturing. Manufacturing company. In manufacturing company, we need this one, but not yet. This one will disappear. I don't need this one. Or maybe I need it. We'll see. But definitely don't need this one yet. We're gonna insert some stuff. So in manufacturing company, what we said, we have 3 inventory accounts. That's the tricky part here. We have 3 inventory accounts. So we have to make this one a little bit smaller and copy it 3 times. Now I need some space on this side. Here we go. Now we have it 3 times. What will be the first one? The first one, now we're going to call it raw material. Second one, we're going to call it work in process. And the last one, we're going to call it finished goods. Now the question here is, we don't need this. I don't need this. Not those arrows yet. Not those one. Not this one. Nothing. The question is, from where the cost of goods sold is going to come in this case? Obviously from finished goods. So in order to calculate the cost of goods sold, we need the beginning balance of the finished goods. Debits that coming in the finished goods account and the ending balance. From where the debit's gonna come? Those gonna come from the work in process. When? When we manufacture the finished good. Since we need to manufacture the finished good and that finished goods gonna come with a certain cost, we're gonna call it cost of goods manufactured. So once we have that cost of goods manufactured, we're gonna flip it to the finished goods account. And once we sell it, it's gonna become cost of goods sold. Not before we sell it. We have to sell it. So, but in order to manufacture it, since we're manufacturing a product, we're gonna have 3 costs. Direct material is the first, direct labor is the second, and manufacturing overhead is the third one. Once we have those 3 costs all together, then we can say, oops, I have a product. Not before. I have to have those 3. Let me choose the right shape. That's the right shape that I need. Once I have those 3 costs, I have product. Once the product is ready and everybody confirm that it's ready, we can move it from the working process into the finished goods. Now the question is, from where are we going to get the direct material? Direct material, we're going to get it directly from the raw material account. But in order to get it from the raw material account, we have to purchase it. Make sense? Once we purchase it, then we can use it in our production and that become direct material become part, raw material become direct material part of the working process. There we're going to meet with the direct labor manufacturing overhead. Once those three are completed, become cost of goods manufactured. Once then it's moved to the finished goods. Cost of goods manufactured is moved to the finished goods. And once the goods are sold, we get in cost of goods sold. So for that reason here, that our calculation here for the cost of goods sold will be very, very, very long, because we have to do this calculation 3 times. So let's push those lines down and see what we're gonna have. First, let's go and find how we're gonna get cost of goods manufactured. In order to get the cost of goods manufactured, we need to know direct material, direct labor, manufacturing overhead, correct? But before we know that, we need to find out how we're gonna get that direct material. Since direct material comes from the raw material account, we have to start our first calculation, which means how we're gonna calculate the direct material that we used. So, direct material used, we're gonna start. Beginning balance for the raw material account. Then we're gonna add the purchases. And then we're gonna have raw material available for use, correct? Once we deduct ending balance of the raw material, we're gonna get direct material used. Make sense? Once we have the direct material used, we're gonna move to the next account now. We're gonna have here direct material used. We're gonna add the direct labor. We're gonna have manufacturing overhead. Once we have those three, we can say, oops, we have the cost current for the product cost for the period. That will be the product cost for the period. Is it
Ivan?
gonna be? Yes.
So for the direct material use, is it the same as the lump sum for the credit side of the raw material?
At this point, that's how we're gonna call it. Yes. At this point, yes. Will be directly the credit that we're getting from the raw material account.
Okay, for the direct labor and the
Direct labor and manufacturing here, those will be given to you. You don't have to worry about those ones. Those in the questions at this level is going to be given to you. You just have to add it to the direct material in order to get the product cost for the period.
we need to make the journal entry for the.
No,
for
you
the-
you don't need to do the journal entries. No journal entries at this point.
Oh, thank you.
Then, so now my goal is here to get the cost of goods manufactured. I have my debit. This is my debit, correct? All those three represents my debit. I need the cost of goods manufactured. What do we need to do? I need to add the beginning balance, since it's balance sheet account in the working process. And once I add this, I'm going to have the total product cost or manufacturing cost ready to be transferred. Let's call it product. Shorter. Manufacturing is too long. Total product cost, which are ready to be transferred to the next stage. Once I deduct ending balance of the working process account, I'm going to get cost of goods manufactured, correct? Now I have my cost of goods manufactured. But don't forget, our objective is to get cost of goods sold. So what do we need to do? Once we have our cost of goods manufactured, we need to add beginning balance of the finished goods account, and that's going to give us finished goods available for sale. Once we deduct less ending balance of the finished goods account, we're going to get our cost of goods sold. That's how we're going to calculate cost of goods sold. Basically, we have to go to Metrotown 3 times. 1, 2, 3. So let's do it. Raw material. We have 20. We purchase 100. That's give us total of 120. Ending balance is 5. So direct material that we use, in this case from our manufacturing, will be 150. Now those 150 is gonna move here, right? 150 from here. Not that one, this one. Then we need direct labor. For direct labor, let's put 50. And for manufacturer overhead, let's put, that's too close. Let's move it a little bit further. For the manufacturing cost, let's put 80. So the total amount here, let's put it 80, 75 here. 240. 240 is our cost for the period, product cost for the period. Once we add the beginning balance, let's change it to 30 here, and ending balance, let's change it to 50. So we're going to have direct material 150, direct labor 50, and manufacturer overhead 75. Once we add the beginning balance, which is 30, we're going to have total product cost, which is available to be transferred further, 270. 50 is our ending balance. Once let's deduct it, and let's see how much will be our cost of goods manufactured. Cost of goods manufactured turned out to be 220. Now, that 220 is going to come here, 220. Let's put some new numbers, 40 here, and no, not 40, 10 here, and 40 here. So our cost of goods manufactured was 220. 220. Our beginning balance is 10. I should make this interactive so we don't have to calculate those one all the time or enter it manually. Now the Excel spreadsheets can read from itself, so we don't have to worry about anything. Okay. So available for sale, we have 230, which is sitting and ready for the customers. Our ending balance is 40. So how much we sold? We sold 190. That's how we get cost of goods sold in this case. So here on the income statement, we're going to start with the sales. We're going to start then the first calculation, second calculation to come up with the cost of goods manufactured. And from the third calculation, we're going to get our cost of goods sold. So here, it's not going to be beginning balance of the inventory, it's going to be beginning balance of the finished goods. Purchases, we're not going to add the purchases, we're going to add cost of goods manufactured. And then we're going to have not finished inventory, we're going to have finished goods available for sale. And less the ending balance of the finished goods, we're going to give us cost of goods sold. Make sense?
So Evan, at
Yes.
the end of at the end of period, do we have to close the accounts in working process?
Which one counts?
So the working process, something like the direct material or direct labor.
Let's go to the first part that we did. What kind of accounts are those? For which statement they belong?
They are inventory.
Inventory, or which statement, which financial statement those accounts, all those accounts, three accounts belong to?
Balance sheet.
Balance sheet. Do we have to close the accounts in the balance sheet?
No.
No.
Thank you.
That's why they call balance sheet accounts, right? Because they're always going to have balance, unless we decide to close the company, right? Once we decide to close the company, there will be no balances. But since they're balance sheet accounts, yes, they're always going to have balance. We don't have to worry about, we don't have to close it. We just have to come up with the right calculations in order to calculate the cost of goods sold, which is going to be part of the income statement. Make sense? And then we have to close the income statement at the end of the period.
Got it. Thank you.
Right? Okay. Now let's repeat everything through the slides. Any questions on this flow of the information? How we get direct material use, how we get cost of goods manufactured, and how we get cost of goods sold. Any questions? Is it clear?
Somewhat, but I think I would have to do like some of the practice problems from like the assignment to like fully get it into my brain.
Okay, let's keep going. Let's keep. That was the first time that you're seeing this. I understand that, but let's keep going and see. Let me see first. Is there any questions on the chat? There's no questions on the chat. Let's move now back to the slides and focus on the slides. And you're going to see the slides now. How they're going. First, the accounts. We already said beginning balance plus debit. Now, how are we going to get the debit? How are we going to code the debit? It doesn't matter. The debit is still debit, right? Now, is it going to be additional to the inventory? Is it going to be purchases? It is going to be something else. It still doesn't change the fact that it's just simple debit on the asset account. It will be equal to the ending balance plus withdrawals from the inventory or cost of goods sold or something else. Direct material used, you name it. It doesn't change the fact that this is withdrawals represent the credit. So remember, it is beginning balance plus the debit is equal to the ending balance plus the credit. And then play with the formula to find either beginning balance, either the debits, either ending balance, either the credits. All the three other will be given to you. So you have to find one of those. Let's go with the first question. Shall we do this using the Excel spreadsheet? Do you want to?
Give me a little.
Okay, let's use the Excel spreadsheet. Let's make it easy. For this one, we need the merchandising company, right? Let's copy this merchandising company. Let me share my screen. Second. Okay, and I'm gonna pause the question right here as a picture. Can you see the question?
Yes.
Okay, so what we have? In the inventory, we have a beginning balance of 1,000. Okay, we have purchase 100 and we saw 300. The question is, what's our ending balance is equal to what?
Hippie.
Okay, let's do this. What will be that? Which formula are we gonna use first? We're gonna use exactly this formula, right? Beginning balance plus the debit minus credit is gonna give us ending balance. So Our beginning balance is 1,000. Our purchases are 100. How many we have now? 110. What's our less? In this case, we're gonna switch them. We're gonna move it to the credits, and that will be our ending balance. We're gonna just little modification of the formula. Now the question is, this one is equal to that one. So what's happened with the ending balance? Everybody got this? Are you with me, people?
Yeah.
Okay.
Yes.
So what's happened? You have in your pocket $1,000. You withdraw 100. You spend 300. How many dollars you have in your pocket?
600.
600 only? 1,000 plus 100, that's 1,100 minus 300. That should be more like a
Sorry, I meant 800.
800, yes. So the other way, there's another way to see this. Watch this. You have in your fridge 1 liter milk. You bought 100-gram milk, 100 milliliters. Then you use 300 milliliters. How many milliliters milk left in your fridge? And we can replace it with this, with so many different things. At the end of the day, we're not changing the fact that whatever you had plus whatever you added to what you have minus whatever you used is going to give you what's the new amount that you have now. Okay, let's go back to the slides now. We're done with this. We had the answer. Let's apply the answer and see if that's the correct answer. Should be, right? 1,000 plus 100 give you 1,100 minus 300 give you that 800 that we needed. Now the scheduled cost of goods manufactured. Now, in order to calculate the cost of the raw material, direct labor and manufacturing overhead, which are used in production. Once we do that, we're going to calculate the manufacturing costs associated with the goods that were finished during the period. So what we're going to do? We're going to start with the raw material. Now we're moving to the production company. Raw material. Beginning balance of the materials. Inventory plus the purchase of the new raw material is going to give us the raw material available for use in production. Less the ending balance is going to give us a raw material that we use for our production. Once we add direct labor and manufacturing overhead, the conversion cost, in other terms, we have the direct material. Now we adding the conversion cost, which converting direct material into finished goods. And we're going to have the total manufacturing cost for the period, or total product cost for the period. Once we add the beginning balance of the work in process, then we're going to have the total work in process for the entire period, which is sitting available to be transferred further. When we deduct the ending balance on the work in process, we're going to get the calculation for the cost, number of the cost of goods manufactured. Do we want to know the cost of goods manufactured? Absolutely. Why? Because that will become our cost of goods sold. So we have to make sure that we're selling our products higher than whatever cost us to manufacture those products. So once we get the cost of goods manufactured, we're gonna add it to the finished goods account. Since it's the balance sheet account, we're gonna add the finished goods beginning inventory. That's gonna give us cost of goods available for sale. We're gonna deduct the ending finished goods inventory, and we're gonna get cost of goods sold. So, how is the manufacturing cost flow process? First, on the cost side, we're gonna flip it first to the balance sheet, and then we're gonna move it to the income statement, right? So we're gonna purchase first the raw material, put it in the raw material inventory account. Then we're gonna, from the raw material, we move the direct material into work in process. In work in process account, direct material, we're gonna meet with the conversion cost, direct labor and manufacturing overhead, until become a finished good. Once become a finished good, from work in process, gonna move to the finished goods. Since we haven't opened our company just to keep our products, we're gonna sell that product. Once we sell it, become a cost of goods sold. For the rest of the costs and administrative expenses, we directly gonna expense them into the income statement. Example for the manufacturing cost will be direct material is 500, direct labor 100, overhead 200. Those three together is gonna meet each other in work in process inventory account. Once we say product is complete, it's gonna move to the finished goods. Once we say product is sold, become cost of goods sold. Selling administrative expenses, those are directly expensed and moved to the income statement. They don't have to go through one account, another account, and third account. They directly go to the income statement expense account. We're done. Now let's go and do this example. Go over all the calculations one more time. So here we're gonna have beginning raw material inventory was 32,000. During the month, 276,000 of the raw material was purchased. At the end of the period, we check how much raw material we have left. We found 28,000. What's the cost of direct material that we used? Are we going to the Excel spreadsheet or you're good? What do you say? Okay. So what's the correct answer?
E.
Some say C, some say B. C. Okay, let's see. 32 plus 276 minus 28 should give you 280. Correct? Let's see what is our correct answer. Correct answer is C. 32 plus 276 is going to give us how much we have available. 308 minus 28 is going to give you 280. Direct material used in cost of the product. Now, once we get the direct material 280, that direct material has to meet each other with direct labor and manufacturing overhead, which those two direct labor, direct manufacturing overhead is going to convert it into the product. So the question is, how much is the total manufacturing cost for the period? Can you calculate it? B seems like a right answer. Let's move to the next one. Yes, we're going to add those three together, 280 plus 375 plus 180. We're going to get 835, which is the correct answer. Let's move to the next one. Now, that become our cost of goods manufactured. Cost of goods manufactured is going to move to the working process, where in working process we have 125 beginning balance. At the end of the period we check, we have 225 in the working process beginning balance. 200 is the ending balance in the working process. how much is the cost of goods manufactured? Seems that the right answer, Jim. Jim, thank you. So 125, 835 is going to give you 960 minus 200, 760. Great job, Jim. Now we have our cost of goods manufactured. What we have to do, we have to transfer those goods into the finished goods account. In the finished goods account, we're going to check what was the beginning balance, what's the ending balance, and we're going to figure out how much is the cost of goods sold. Question for you, before you start the calculation, before you jump on the calculations, do you see something interesting here? It means what's happened with the beginning balance? Did it get higher at the end? Is it higher at the end or lower?
Or the higher.
It went higher. Is that good for us? Do you prefer to have finished goods, more finished goods sitting in your warehouse?
No, I
No.
want in the lower.
So what that means, if the ending balance is more than the beginning balance, means that we cannot sell whatever we manufactured, correct? Make sense? So we manufacture $760,000 material, but we out of 760, we add 20,000 to our ending balance. So we haven't sold what we produce. Make sense? Whatever we manufactured, we cannot sell it. And we keep 20,000. So how much we sold? 20,000 less than what we manufactured. So the answer will be another 20,000 is the build-up in inventory. But how much we sold is whatever we manufactured less the 20,000 that we stays in our inventory. So the correct answer here will be 740. Make sense? Beginning balance plus the cost of goods manufactured less ending balance going to give us 740. So for the different, again, as I said in the beginning, for the different purposes, we're going to have a different cost classifications. For the purpose of preparing the financial statements, we're going to have the product cost or inventorable cost, which is direct material, direct labor, manufacturing overhead, which we just sold. And we're going to have the period cost, which is the non-manufacturing cost. For the predicting how the costs behave, we're going to have a variable cost and fixed cost. If we have to assign the cost to the cost object, we're going to have direct cost and indirect cost. And for decision making, we're going to have three types of cost: differential cost, sunk cost, and opportunity cost. Let's move now to the next classification on our chart. The first classification based on the external financial statements, we already made that one. Let's move to the second one, based on how the costs behave. Chapter 3, it's going to cover again, we're going to repeat again how the costs behave. Before we move further, I want to remind you something, that the cost is a mathematical function between two variables. Does that make sense? Mathematical function, cost is always mathematical function between two variables. One variable is the quantity, the other variable is cost. So basically, if you pay $2 for a coffee, that's because you're buying one coffee and the cost for one coffee is $2. Now, how the costs behave, they behave two ways, as a variable cost and as a fixed cost. Variable cost always changes with the level of activities. If we use it, we have to pay it. If we don't use it, we don't have to pay it. Fixed costs, on the other hand, remain unchanged when the activity changes. So let's see now. For the fixed cost, let's use for the variable cost first. For the variable cost, not texting, let's use something else. Let's use tomato. If you buy tomato, let's say the cost per tomato is $2. If you don't buy tomato, your cost will be $0. If you buy 1 pound tomato, you have to pay $2. If you buy 2 pounds tomato, you have to pay $4. So more you buy, more you have to pay. How much more? Depends on how much you want to buy. What's the quantity of the pounds that you want to buy? More pounds you buy, more you have to pay. If you don't buy anything, you don't have to pay, cost is $0. How about the cost per pound? Well, the cost per pound is always going to stay $2, as long as you're buying the tomatoes. If you don't buy tomato, cost is $2. If you buy 1 pound, cost is $2. If you buy 10 pounds, cost is $2 per pound tomato. What drives the total cost in the in the variable cost then? What is the thing that drives the variable cost? Well, different things. First thing that you drive is the units that we produce. Obviously, if we produce more finished goods, we need to have more direct material. So that's the units that we produce is going to drive the cost of the material. Machine hours. If our machine's working more hours, yes, we're going to produce more products, but our cost is going to increase as well because we have to use electricity. You have to use those people that working on the machine. We have to use more materials to produce the product which is on the machine. Labor hours is the other thing that drives the variable cost. More people work for us, more we have to pay. And the other one is the miles driven. If you drive more miles, if you increase the mileage of the driving, you have to pay more. Fixed cost. Let's see about the fixed cost now. Fixed cost, you can look at the fixed cost as your rent. It's paid on the monthly basis. So you're renting your apartment for 1 month and that cost stays the same. Make sense? The monthly cost is not going to change. Total cost always going to be the same. How about the cost per unit? Well, how many people is going to live in that apartment? Let's say, example, let's say that you're paying $1,000 for 1-bedroom apartment. If one person lives in that apartment, how much is the cost per person? Obviously, cost per person will be $1,000, correct? If 2 people live in that apartment, cost per person is going to start going down. It's going to be $500. Reduced. If 4 people living in that apartment, the cost even is going to go even less. Now the cost per person is $250. 10 people living in that apartment, cost per person will be only $100. So what's your incentive here? To put as many people as you can in that apartment. That's the only way you to reduce the cost per person. Why? Because you already paid a fixed cost for the entire month. Now you have to make it work for you. Another good example is, let's pretend that you're going for ski, or not right now, but let's say tomorrow you're going for ski because you're expecting that snow to come. And you're paying $100 to ride ski from 6 o'clock to 10 o'clock on Seymour Mountain, let's say. If you make only one run, how much is the cost for that run? Obviously $60. So what's your incentive? To make as many runs as you can. That's the only way you to take advantage of the fixed cost that you already pay for that activity. Relevant range. What's the relevant range? Relevant range is the range of activity where all the assumptions about the variable costs and fixed costs are valid. Simple example, I'm going to give you a simple example about the fixed cost and the relevant range. Imagine this. Instead of teaching for Douglas, I'm teaching this course on my own. I'm approaching Douglas College and asking them, hey, can I rent a room in the college? And they say, yeah, no problem at all. But the room's gonna have only 20 chairs inside. That's it. And for that room, you have to pay $2,000. And I have simple math. So if I have 20 students, which I'm gonna charge $200 for this course, I'm gonna make maximum of $4,000. Once I pay my rent for the room, I'm gonna cash $2,000. Easy. Question for you. If I have 5 students on the waiting list, what should I do? Well, let's say I have 5 students on the waiting list. So I'm going to Douglas College and asking, hey, can I have 25 students? And they say, technically you can, but you need 25 chairs. I say, yes. Well, if you want to have 25 chairs, then you have to rent bigger room. But that bigger room have the maximum capacity of 40 chairs, and the cost is double. Instead of 2,000, now you have to pay $4,000 for that room. So the question is, if I have 5 students on my waiting list, should I rent that bigger room for $4,000? No, that will be the logical. Why? Because my cost is doubled, but the 5 students, it's going to give me additional students, going to give me only $1,000. So technically, I'm going to lose $1,000 right away, instead of making 2,000 in the small room. I need at least 10 students in my course to cover the additional $2,000. If I have more than 10 students, then I'm gonna generate additional income to the 2,000 that I can generate with 20 students in the small room. Make sense? That's your relevant range. Relevant range in this case is the 20 students or 20 chairs in the room. Once I move to the next relevant range, my fixed cost is gonna double. So let's make a conclusion on how the costs behave. Variable cost in total always gonna go up. More you're using, more you have to pay. Less you're using, less you have to pay. If you don't use it, you don't pay. But variable cost per unit always gonna remain the same. Now fixed cost. Total fixed cost always gonna stay the same. But fixed cost per unit always gonna go down. More we're using the fixed cost, less we have to pay. for the single units. I mean, the average cost per unit goes down. We still have to pay the total fixed cost, but the average cost per unit goes down. So let's see this question. Which one of the following costs will be variable in respect for the number of cones sold with Baskin-Robbins shop? You know what the Baskin-Robbins shop is, what they're selling. They're selling ice cream. They have a store in Metrotown. So let's see which one of those below are variable. Cost of the lighting in the store, is that a variable cost? What do you think?
No.
Absolutely. Regardless if we have a customers or not, regardless if we're selling ice cream or not, we still have to pay for the lighting. So definitely not a variable cost. Wages of the store manager.
No.
No. We still have to pay that person regardless if we have a customers or not. How about the cost of the ice cream?
Yes.
Yes. How about the cost of the napkins for the customers?
Yes.
Yes. So the variable cost is the cost of the ice cream and cost of the napkins to the customers. So let's see in another classification now how assigning the cost to the cost object. We have two options here. It is going to be direct cost, it is going to be indirect cost. Direct cost is the one that can be easily traced to the product. Indirect cost is the one that cannot easily be traced to the product. The simple way you to figure out which one is direct and which one is indirect, the costs that have adjective direct in front of the name of the cost, it will be direct cost. The cost that doesn't have adjective direct will gonna be indirect cost. That's how simply can remember it. So every time when you see material, ask me what kind of material is this? Direct material. Oh, that's direct cost. Indirect material? No, it's not direct cost, it's indirect cost. Labor. Is it direct labor? Yes, it is. No, that's mean direct cost. Indirect labor? No. It's not direct cost, it's indirect cost. So direct cost is direct material, direct labor. Why? Because they have the adjective direct in front of the name. Indirect cost is manufacturing overhead. Indirect labor, indirect material. Decision making. Last classification, decision making. For every decision, in order to make a decision, you have to have a choices. You have to make a choice between at least two alternatives. If you have only one alternative, there's nothing to choose. So if I have two alternatives, which cost I should consider? Only the cost and benefits, which are different between one alternative and the other alternative, in relation to the decision that you have to make. All the other costs and benefits should be ignored. For example, if you decide to go to Miami or Hawaii, in both cases, you have to take the cup to the airport. So the cost of the cup is not going to be considered for your decision where to go. Why? Because it's not different between should I go in Miami or should I go in Hawaii. In both cases, you have to go to the airport. So for that reason, cost of the taxi or cup is irrelevant. So let's see this one. Imagine this person, one person is offered a job, 1,500 per month. He's currently working for 1,500 a month in the hometown. There's a job offering in the neighboring city, which pays 2,000 per month, but the person has to spend now commuting cost of 300 per month. Based on the cost, is the person going to accept the offer? Obviously, between the two offers, he's going to make $500 more, but he has a differential cost that between one alternative and the other alternative, which is increasing $300. So yes, he's gonna end up making additional $200. In that case, should I take the job? Based on the cost, yes. The other thing is potential benefits which are given enough for one alternative and the another alternative, when we select another alternative, is called opportunity cost. So opportunity cost is the cost that you giving up by choosing the alternative. The tricky thing with the opportunity cost is you don't have to pay opportunity cost. The opportunity cost is not the cost that you have to pay, but you have to consider it for your decision. Sunk cost. Sunk cost is the cost that already happened and you cannot change it, neither now, neither in the future. For decision making, that cost should be absolutely ignored. So if you buy a car 10 years ago for $10,000, $10,000 are pure sunk cost. Because no matter what you're going to do, you cannot change that cost. Let's go over the last few questions and complete this chapter. Now, let's suppose that you're trying to decide whether to go, you're trying to go to Portland to attend the concert. You have two alternatives. One, to go with the train, to take the train. The other one is to drive. Cash is not your problem. You have an endless amount of money. So, the question is the cost of the ticket relevant in this decision?
Yes.
Yes. Why? Because it's one of the alternatives. Absolutely correct. Yes. Now, next question. Let's suppose that, again, you're trying to go to Portland and you just try to choose between drive your car or take the train. Cash is not your problem again. The question is the annual cost of the licensing your car relevant for you this decision?
No.
No. Why? Because it's sunk cost. You already pay for it. You cannot go back and change it. The other example will be, how many of you travel this year? Did you go somewhere? Anyone
Yes.
anyone who has a car pay insurance and travel this year? Yes. Okay. Once you go to the airport, have you seen agent from ICBC to ask you, hey, where are you going? I'm going out of the country. For how many days? For 10 days. Oh, okay, that's your rebate for 10 days of not using your insurance. Have you seen anything like that? No. ICBC never gonna give you the money back. Once they get your money, that's it. It's your choice to drive your car or not to drive your car. So in that case, the licensing cost is sunk cost, so it's not considered. The last question here is, let's pretend that your car can be sold for $5,000 right now. Is this a sunk cost?
No.
Is it cost at all?
What is the sunk cost mean? I don't quite understand.
Cost is something that you have to spend. Think about it. Is it opportunity cost? Is it cost at all? Yeah, the car to be sold. So what is it? It's a revenue, right? Has nothing to do with the cost in this case. So yeah, definitely it's not a sunk cost. Definitely is not a sunk cost. But furthermore, it's not cost at all. This is something that's gonna come in your pocket. It's not going out of your pocket. It's not cost at all. So let's summarize. We have for financial reporting, we have two types of cost: product or inventoriable cost and period cost. For predicting the cost behavior, we have variable and fixed cost. For assigning cost to the cost object, we have direct cost and indirect cost. And for decision making, we have differential cost, we have opportunity cost, and we have a sunk cost. And that concludes chapter 2.